A credit score is a three-digit number that reflects your financial trustworthiness. It tells lenders how likely you are to repay a loan on time. A higher credit score means you're considered less risky. This can lead to lower interest rates on loans and credit cards. Your credit score is based on your credit history. This includes things like how many credit cards you have and how often you make payments on time. Imagine getting a lower interest rate on a mortgage or car loan. That's the power of a good credit score. But a low credit score can make life harder. You might face difficulty getting approved for loans or credit cards. That's why it's crucial to understand and actively manage your credit score. Your credit score is influenced by several factors, each playing a role in determining your credit worthiness. Payment history. This is the most significant factor, accounting for a large portion of your score. Late payments, missed payments, and collections can severely damage your score. Credit utilization ratio. This refers to the amount of credit you're using compared to your total available credit. Keeping this ratio low, ideally below 30%, demonstrates responsible credit management. Credit mix. Having a mix of credit types such as credit cards, installment loans, and mortgages can positively impact your score. Length of credit history. A longer credit history generally contributes to a higher score. Closing old accounts, even if unused, can shorten your credit history and potentially lower your score. New credit. Opening several new credit accounts in a short period can negatively impact your score. Only apply for credit when needed. Improving your credit score doesn't happen overnight, but consistent effort and smart financial habits can make a significant difference. Pay your bills on time. Set up payment reminders or automate payments to avoid late fees and negative marks on your credit report. Keep credit card balances low. Aim to keep your credit utilization ratio below 30%. Don't close old credit card accounts. Even if you don't use them, keeping old accounts open can help your credit score by lengthening your credit history. Become an authorized user. If you have a family member or close friend with good credit, ask to be added as an authorized user on their credit card. Dispute errors on your credit report. Check your credit report regularly for inaccuracies and dispute any errors with the credit bureaus. Credit repair companies offer to help improve your credit score by disputing errors and negotiating with creditors. While they can be helpful in some situations, it's essential to proceed with caution. Understand their limitations. Credit repair companies cannot legally remove accurate negative information from your credit report. Beware of companies making unrealistic promises or guaranteeing specific score increases. Research thoroughly. Before hiring a credit repair company, research their reputation and services offered. Understand the costs. Credit repair services can be expensive. Consider whether you can achieve similar results on your own. Know your rights. Under the Fair Credit Reporting Act, you have the right to dispute inaccurate information on your credit report yourself. Remember, improving your credit takes time and consistent effort. Credit utilization plays a crucial role in determining your credit score. It reflects how much of your available credit you're actively using. Maintaining a low utilization rate demonstrates responsible credit management and can significantly impact your score. Calculate your utilization rate, divide your total credit card balances by your total credit limit. Aim for 30% or lower. Experts recommend keeping your credit utilization below 30%. Pay down balances strategically. Focus on paying down balances on cards with higher interest rates or larger balances first. Don't max out your credit cards. Avoid using more than 30% of your available credit on any single card. By actively managing your credit utilization, you're demonstrating to lenders that you're a responsible borrower. Your payment history is the most significant factor influencing your credit score. Consistently making on-time payments is crucial for building a positive credit history. Set payment reminders, use calendar alerts, mobile apps, or email reminders to notify you of upcoming payment deadlines. Automate payments. Consider setting up automatic payments for your bills, especially for recurring expenses like credit cards, utilities, and loans. Communicate with creditors. If you anticipate difficulty making a payment, reach out to your creditor proactively. Prioritize debt payments. If you have multiple debts, prioritize payments based on interest rates and balances. Check your statements regularly. Review your credit card and bank statements regularly for any unauthorized charges or errors. By consistently making on-time payments, you're building trust with lenders and setting yourself up for favorable credit opportunities. Regularly monitoring your credit report is crucial for maintaining a healthy credit profile and protecting yourself from identity theft. Obtain your free credit reports. You're entitled to one free credit report from each of the three major credit bureaus, Equifax, Experian, and TransUnion, every 12 months. Review your reports carefully, check for any errors in your personal information, such as your name, address, and social security number. Verify the accuracy of all credit accounts listed and report any unfamiliar accounts or activity. Dispute inaccuracies. If you find any errors on your credit report, dispute them with the respective credit bureau. Set up fraud alerts. Consider setting up fraud alerts with the credit bureaus if you suspect identity theft or fraudulent activity. Monitor for suspicious activity. Check your credit report regularly for any unauthorized inquiries or accounts. By actively monitoring your credit report, you're taking control of your financial well-being.